Fetch.ai is building autonomous AI agents, decentralized compute infrastructure, a brand new blockchain purpose-built for AI workloads, and it sounds like the exact thing the market should be rewarding. Then you look at the price, which is sitting around 22 cents today, down roughly 93% from its all-time high, and you wonder if you're missing something. In this video, we'll dig into why the price feels disconnected from the tech. We'll break down the on-chain reality. We'll analyze the charts and the macro setup and lay out the realistic 2026 price targets based on market cap math. Plus, my personal trading plan if you're looking to position yourself. If you're into such crypto breakdowns, this is my invitation to you to subscribe to the airdrops.com channel. And now, let's get into FET. This is not financial advice, always do your own research. FET hit $3.45 in March 2024, riding the wave of the AI narrative that was dominating every conversation in both crypto and traditional markets. At that peak, the project had a market cap of around $6.7 billion, 6.7, putting it in a fierce race for the top spot among AI tokens alongside BitTensor, for example, Render. Since then, however, the tune has changed and the drop has been severe. 93% from the peak to where it trades today at around 22 cents with a market cap of roughly $500 million. The cycle low came in at around 13 cents, I remind you that, in late 2025, before the price bounced back to the current levels. So there has been some recovery, but it's quite modest. And what makes this particularly frustrating for holders is that the AI narrative that drove FET to 345 hasn't gone away. If anything, it's gotten bigger. So why is the price here? Well, to understand the price action, you need to understand what happened in 2024 and 2025. Fetch.ai merged with SingularityNet and Ocean Protocol to form the Artificial Superintelligence Alliance, with a plan to unify their tokens under the ASI ticker. The concept made sense on paper. Build something that could compete with centralized AI. But the execution created a massive supply event. Over 1 billion new FET tokens were minted to absorb Ocean and AGIX holders at fixed conversion rates, which added significant sell pressure to the market. Then, trouble in paradise. In October 2025, Ocean Protocol pulled out. They withdrew their directors, resigned from the alliance, and announced they were going independent. And this split wasn't clean. Fetch.ai accused Ocean of converting hundreds of millions of Ocean tokens into FET and selling them, with around 286 million FET allegedly dumped during this exit. The token price fell sharply in the days following Ocean's exit, though Ocean's founder publicly denied the exit was responsible for the price decline. The dispute eventually settled, with Ocean returning those tokens, but the damage to the sentiment was already done. Trust, once broken in crypto, takes a long time to rebuild. What remains today is Fetch.ai, SingularityNet, and Kudos, smaller than the original vision, but more focused. Once you separate the drama from the actual product work, the picture gets more interesting. 3 things impress me here. 1, the ASI Cloud, which came out of beta in December 2025 and is now handling live AI workloads. It gives developers permissionless access to GPU compute payable in FET without the KYC hoops of centralized providers. 2, the ASI Create, a no-code platform for building and deploying AI agents that entered its closed alpha in February 2026, with an open beta planned for later this year. And finally, 3, ASI Chain, which is a block DAG-based layer 1 built specifically for AI native applications, launched its DevNet in October 2025. And it's now progressing toward a public testnet, with mainnet targeted for late 2026 or maybe early 2027. On the tokenomics side, the Alliance has an active earn and burn mechanism, officially announced in November 2024, where a portion of fees generated from ASI services is burned, targeting a reduction of roughly 35 million tokens in its first year. It ties supply reduction directly to network usage, which is exactly the kind of structural tokenomics story that tends to actually age well. On to the chart now, which tells a clear story too. Fed has been in a downward trend since its March 2024 peak. Lower highs and lower lows on the weekly time frame throughout all of 2025. The price made a double bottom at around 13 cents and has since recovered to the current 24-cent range. Right now, the price is up 70% from the bottom, but it's still not broken into the bullish structure. The price needs to break above the previous high so that the trend turns bullish again, remind you. Once we break that high with volume, the first target for Fed would be the one in the $1 zone, which is a previous support and resistance zone, and also a psychological number. In case we reclaim that $1, the next level of resistance would be at the 618 Fibonacci at $2.20. This bullish case will be mostly dependent on Bitcoin potentially making higher highs and possibly reclaiming the 200 daily moving average. But if we fail to flip the $1 resistance zone, we can definitely drop lower to take out the double bottom liquidity and drop to the next strong resistance zone, which is at around 5 to 7 cents. That's certainly not going to be the best scenario for Fed, as it spells another 70 to 75% drop. Keep in mind that the chart isn't going to flip on its own either. The macro matters a lot for crypto prices to go up or not. Fed needs two things to align. The first is PMI staying above 50, which is an indicator for the business cycle. March came in at 52.7, which is expansion territory and historically a green light for risk assets. We have that condition right now, but what we don't have is the second one, actual liquidity expansion. The Fed ended quantitative tightening on December 1st, 2025, but stopping the drain is not the same as turning the tap on. The Fed hasn't started QE, and with the Iran conflict driving oil past $100 a barrel since late February, inflation that was sitting at 2.4% in January is now expected to accelerate. The Fed held rates steady at 3.5% to 3.75% at the March meeting, and if we get a rate cut at all, it might be the only one for all of 2026. Yet, I'm not sure we'll even get that. Bank of America, for instance, has announced the possibility of rate hikes if oil stays elevated. So, the situation right now is that one condition is green, one is red. Until Bitcoin starts making higher highs and the Fed gets room to ease, the token of Fetch.ai will probably struggle to make new highs. But when both conditions align and BTC starts going higher, the setup we just looked at on the chart becomes very probable. Until then, patience is key. Now let's do the math. Fed's current market dominance sits at roughly 0.02% of total crypto. The highest its dominance has been is 10 times higher, 0.2%. And as we mentioned, for the bullish scenario, both macro conditions should align. That's PMI staying above 50 and liquidity expanding. Looking at the whole crypto sector, a realistic bull case for the total crypto market cap in that environment would be $5 trillion. With these in mind, let's do the bullish math in two hypotheses. Hypothesis A says that Fed reclaims 0.15% market dominance just below its previous peak. That means a market cap of $7.5 billion and the price of around $3.25, essentially back at the all-time high. In hypothesis B, the AI agent narrative catches properly and the Fed dominance reclaims the 0.25% level, matching its previous peak. The market cap reaches $12.5 billion and the price gets to around $5.40, which is a serious new all-time high. But be wary, folks. If macro never aligns and inflation stays high, we get no QE. We need to hedge here, as Fed could revisit the next support at around 5 to 7 cents. Staying in the cash certainly beats that trade. Here's my honest take on Fed. I'm not convinced that's worth buying right now. 3 things need to change before I change my mind too. First, Bitcoin needs to reclaim and hold above the 200-day moving average. Remember, altcoins don't sustain rallies when Bitcoin is below that level. Second, the PMI needs to keep making higher highs. And third, the Fed needs to signal a clear pivot toward quantitative easing. When we get these three factors in place, I plan on entering in two parts, with 60% upon the initial confirmation and the other 40% for the first proper pullback after the breakout. When it comes to taking profit, here's my intention. 50% at $3.25, which is in accordance with my hypothesis A. Another 30% I'll take at $5.40 if the full bull run unfolds, of course. I'll let the remaining 20% run upward with, of course, trailing stop loss levels. But let me take off the rose-colored glasses for a moment. In case FET breaks below 5 cents, with conviction at that, I'll close my position. And yeah, I'll take the loss and just call it a day. There's always such a possibility, remember. To wrap up, FET has real products, a focused team that is left standing after the Ocean Protocol fallout, and it sits inside the hottest narrative in both crypto and traditional tech. What it doesn't have yet, however, is the macro tailwind it needs. When that comes, the setup could be significant. But until it does, patience is the trade. What is your FET target for 2026? Drop it in the comments below, and if this video was useful to you, then hit the like button, subscribe to the airdrops.com channel for more analysis like this one. Until then, I'll see you. Ciao.